Um, we are going to, this is an interactive presentation. So, you can mute yourself if you need to take a call or you have to talk to somebody, but certainly I want you to feel free to speak up. As you can see when I'm sharing my screen, I may not see you raise your hand. Rach will keep a little bit of track on the chat for us because, and let me know if somebody's got a question, but don't hesitate to unmute yourself and interrupt me if you have to and ask me a question. So I'll tell you a little bit about myself. My name is Kelly McGinnis. I'm actually now the regional senior vice president for prime lending, managing the entire Northeast region from New Jersey all the way up through, Maine, New Hampshire, Connecticut, everything. And I'm really excited because I get to spend a lot of time working with Dawn and Rachel and Bernadette and Crystal at the Association of Realtors on training. It happens to be the thing I love to do the best. And when this promotion came along, I said to them, nope, I'm going to keep doing what I love and we'll keep training and doing workshops and getting good education in the hands of the people, who want it and need it. So thank you so much for joining today. A lot of changes in the mortgage industry and the real estate industry over the last couple of years. So we're going to kind of go through and I'm going to share with you, kind of just general mortgage guidelines and how we look at loans. A lot of times I'll have realtors say to me, I don't understand. These people have great credit. You should just be giving them the loan. Why are they having a hard time somewhere else? And so it's just really, really important to understand kind of why we do what we do, which sometimes seems a little bit insane, but there is really a method to our madness. And then secondarily, at the end of this presentation, every year the association is so great and invites me throughout the year to give you market updates, not only on mortgage rates, but also the local real estate economy. So at the end of this presentation, I'm going to share with you some information about where mortgage rates are going, why they're going there, and hopefully arm you with a lot of good feedback that you can provide buyers and sellers in today's market. So without much further ado, I'm going to get started. And like I said, please don't hesitate to jump in with any questions. So to understand mortgage lending today, it's really important that you understand the mortgage meltdown. So if anybody here was in real estate, and I know by looking at the registration list, I know many of you have been, but if you were in the mortgage industry, in the real estate industry in 2000, you know that we had a booming real estate market from 2000, in Connecticut's case, to about 2008, literally about 2008. And then the world came crashing down. And why was that? Well, there was two big reasons, but I'll talk to you a little bit about how the mortgage meltdown impacted it. Specifically in the 2000s, lenders, I wasn't doing this, but lenders were offering what's now known as subprime loans. And these poor quality loans were being packaged and sold into the investment markets as high quality loans. Investors didn't realize what they were buying, essentially, because they were combining subprime and prime loans together that were, truly not AAA rated, and they were assigning them a AAA rating by the rating agencies. Now, the whole background for the subprime lending market was the expectation that real estate values would continue to rise. So back then, a subprime loan was often a loan where you did not need you did not need to verify income, you didn't need to verify assets. Oftentimes, you didn't even need to have great credit. And what the subprime lenders would do is put those customers into a loan program that was usually a 1 or a 2-year adjustable rate mortgage, with the expectation that as property values continue to rise, they would continue to refinance these clients along the way, essentially kicking the can down the road, if you will. Well, what happened is, started out west. Everything always starts out west and comes east. But out in California, they started to see some employment issues with unemployment. Housing then stalled. People were not making the money they were making because all of a sudden now they were unemployed, and we saw delinquencies and foreclosures start rising. With that, the country actually tipped into what's now known as the Great Recession, and we can debate and contrast whether or not that's because of the subprime crisis or or it exacerbated the subprime crisis. There's a lot of brilliant economists who differ on these opinions, but essentially what happened is we had a perfect storm. We had property values starting to stall and drop, and then we had record unemployment and underemployment. So what's important to understand about those unemployment figures, especially today, because we're going to talk about this in a minute, but many buyers today are thinking that rates are going to, that property values are going to collapse like they did in 2008. And they're kind of salivating at this opportunity, thinking, no, I'm going to wait to buy because we know property values are going to come down like they did 2008 in Connecticut's case through about 2018, right? Well, that's not going to be the case, because back then we had unemployment and underemployment close to 20%. Now, what that means is 1 out of 5 American households no longer made enough money to pay their mortgages. And that was not only subprime borrowers, but prime borrowers as well. So as families were forced to become delinquent and in many cases go into foreclosure because of the unemployment situation, that then turned into a snowball. And we then saw higher delinquencies, higher foreclosures. And then we started to see something called strategic foreclosures, where especially out west, you would have 600 homes in a subdivision, property values are tanking, and the borrowers who even could pay their mortgages were electing to let their homes go into foreclosure because they felt they would never recapture equity. I mean, homes that they bought for $500,000 were now worth $200,000, and what were they supposed to do? So it was really, really an epidemic. And as a result, the entire mortgage industry had to be revamped, okay? What's important to understand, the data, I am a statistics nerd and I'm a little bit of a data nerd. What's important to understand is when your buyers are telling you or your sellers are telling you that they're expecting property values in Connecticut to come down, you can tell them with almost 100% certainty that we are not expecting that. And that's because currently unemployment in America is hovering around 3%, nowhere near the catastrophic levels. And I've got some more data that I'll share with you at the end of the presentation about Connecticut specifically and why many of us don't believe we're going to see property values come down in Connecticut. But it's really important that people understand that the driving factor between the great crash of 2008 in property values was due to subprime mortgages and unemployment. Now, relative to subprime mortgages, the government got involved. We had the largest legislation ever imposed on the financial services industry in the form of the Dodd-Frank bill. That was Chris Dodd from Connecticut and Barney Frank from Massachusetts put together this bill. Now, in today's lending environment, we are heavily regulated. There are huge fines and additional covenants to lenders if we don't follow the parameters that the government has now put around how we're supposed to be lending to borrowers. And that results in two things. It results in slightly more restrictive lending, and then secondarily, perfect documentation. Now, when we talk about more restrictive lending, compared to the subprime days, yes, of course, we're not giving loans out the way we did back then, and frankly, nor should we. But I've been doing this since, I'm embarrassed to tell you, I've been doing this since 1987. And actually, I find our lending standards today to be more reasonable than they were when I first got into the business. So even though it's more restrictive by comparison to 2000, we're money is flowing, people are getting mortgages, and everything is moving along. The biggest I guess what's most cumbersome for most borrowers is we have to have perfect documentation. So I always tell people getting a mortgage today is a two-part process. The first is what's called ability to repay. And there's an actual legislative law called the ability to repay rule built into the Dodd-Frank law. And what that basically says is that there are parameters that a lender has to meet to show that they lent with good faith to a buyer. We weren't giving away mortgages knowing people weren't going to be able to pay for them, which was predatory lending in the subprime arena, and that we have verified and checked income, credit, what their debts look like, their assets, and what the property is all about. The second step is the documentation must be perfect. And what I mean by this is the subprime loans were really low or no doc loans. Today, Fannie Mae, Freddie Mac, HUD, who buys FHA loans, VA, all lenders today are held to documentation standards that basically also are legislated as evidence that we have followed the ability to repay rule. If we sell a loan to Fannie Mae or Freddie Mac and the documentation isn't perfect, they'll force us to buy the loan back. And that's incredibly expensive for the lender to have to buy a loan back, try to repackage it, or hold it on your warehouse line and not be able to get it back into the hands of a secondary market. So lenders today, are incredibly diligent about making sure their documentation's well. You may also, on occasion, see something come up on one of your borrowers, and you might say, I've never seen that before. In lending, we see this all the time. All of a sudden, we'll start to see underwriting ask for a particular piece of documentation that they've never asked for before. And typically what that means is that the agencies, Fannie Mae, Freddie Mac, HUD, VA, because they've got so much data available to them on loan performance, are seeing loans underperform, going delinquent in particular areas. And so they look to tighten up that particular area. So the technology that we have at our fingertips today to determine what's working and what's not working relative to the loan performance and making sure homeowners have the ability to repay their loans is really, really sharp. And it allows lenders to make quick changes so that we don't wind up with a catastrophic event like we did in the 2000s. Now, as I mentioned to you, ability to repay is actually part of the law. And what the ability to repay rule says is that the lender has to show that they lent responsibly, and as such, they can then feel comfortable that they're not going to have additional liabilities from the government on how we lent the loan. Now, I'll give you an example. So there was a case, oftentimes the laws and regulations for the financing industry are sent out without any guidance on how to implement and enforce the legislation or the rules. And there was a case back in, I think it was 2015. It's when the new loan application came into place and the new closing disclosures came into place. And the rule was set out that we had to issue those closing disclosures a particular way. It's called the TRID rule. And there was a bank out in the Midwest who had retained legal counsel and felt that they were operating within good faith of the law. CFPB, the Consumer Finance Protection Bureau, came in, audited them, found them to be in violation of the rule. Now, the normal fine for the violation was $1 million, and the CFPB could wager additional penalties as they saw fit. So in the chat section, I'm going to go look at this. In the chat section, I want to ask you, what do you think the additional penalties were that were levied against this lender who believed they were operating in good faith for this particular piece of the law? Just out of curiosity, how high do you think that penalty might have been? Or you can yell it out to me if you want to, if you don't want to chat it. Come on, I know there's a brave soul who's going to make a guess.
In billions, I would say.
I'm sorry?
In billions?
No, it wasn't billions, but that million, enough to bankrupt them. Yeah, essentially. That $1 million fine, it was $1 million for non-compliance and then an additional $10 million. So you are all business owners, you run your businesses. How do you run a business and put aside money for loan loss? It's called loan loss reserves, when there's an agency that can come in at random and levy a fine against you that's 10 times higher than what the legislated fine is. So it really creates a lot of challenges for us in lending to be able to be sure that we're perfecting and dealing with the Dodd-Frank rule for the ability to repay rule. Now, the ability to repay rule, I started the conversation, you may recall, by saying, I'll get calls from realtors saying, I don't understand, they have excellent credit. Why are they having such a hard time with this? Because it used to be like, if you could demonstrate somebody had great credit and, they made money, everything should be fine, give them the loan. That's kind of the general thought among the population. but the ability to repay rule mandates that we are evaluating and documenting credit scores, that we are evaluating and documenting income and debt, employment, their assets, and the property. And none of those is mutually exclusive of the other. So you can have someone, the one that tends to really frustrate people the most is you can have someone with excellent credit, making great money, and they've got money for down payment, but their employment is spotty, or they've only been on their new job for 3 months. And it seems unthinkable that we would have a hard time giving them a loan. But employment is one of the criteria that we've got to prove is they've got a history and an ability to prove that this is going to continue. So as a result, sometimes those clients will have a hard time qualifying for a mortgage. So it's important to understand that we have to look at every single one of these categories. It's called layering risk. Now, let's see. Why is this not moving forward all of a sudden? Oh, there we go. All right, so we're going to break down those pieces a little bit. I'm going to give you some education and some feedback on how we look at this and kind of information that you'll have at your fingertips in case questions come up for you with your buyers and sellers. So the first thing we want to talk about is credit, okay? And this is all the buzz, right? Credit scores, you know, everybody's talking about credit scores. Everybody is tracking their credit scores. The most important thing to understand about credit is that it demonstrates a willingness to repay debts. We've seen cases of families who barely have enough money to make their mortgage payments. And when you look at it on paper, you think to yourself, how are they possibly handling all this debt? And yet they've never had a late payment. And conversely, you can see a credit report where you've got somebody who is very financially well off, who is sloppy in paying credit. So credit isn't the ability to repay your debts. We call it the willingness. Credit scores impact the interest rates, the mortgage insurance rates, and it impacts how we underwrite the loan. We deem poor credit scores anything on, and these are arbitrary. This isn't like a published number. It's how, you know, I evaluate it and how we see underwriting impacted. Credit scores of 660 and under tend to be deemed as poor scores, meaning there's going to be an extra layer of scrutiny and extra layers of documentation on those borrowers. We can lend down to a 580 credit score with restrictions, additional restrictions. So that's kind of how we're looking at the scoring system. Good scores would be considered 660 to 720. And I have to tell you guys, I would say in the last 90 days, this may even be trending like good scores at 680, especially if somebody's coming in with a smaller down payment. We're starting to see some real challenges getting the automated underwriting system to approve conventional loans, and we'll go into this in a little bit, with 660 scores and 5% down. So we're starting to see a little bit of tightening up there. And excellent credit scores tend to be anybody whose score is 720 and above. Now, for HUD, it's important to understand FHA loans with a credit score under 640 are 4 times more likely to become delinquent or go into default. And what I love about lending responsibly is when we're dealing with people whose scores fall into that category, we are giving it extra layers of scrutiny. We don't want to put families in a position where they buy a house and then they can't afford their payments. And so the additional restrictions that I'll be highlighting for you are basically an effort to preserve a family from having that catastrophic credit event. Now, let's talk about types of derogatory credit. There's past due accounts, meaning somebody's, you know, currently late on paying one of their pieces of debt. There's accounts that go into collection, meaning they haven't paid the debt, and a collection agency has now been brought in to try to collect on that debt. Most notorious that we're seeing in the collection account are medical collections, and there's actually some pending legislation by President Biden that would mandate that medical bill collections be removed from the credit scoring model, which would be really, really helpful, because oftentimes these are disputes that are going on between the insurance company and the physician's office or the hospital, and it can really have catastrophic effects on someone's credit score But we know that there's a third party involved in creating the problem. Then you have what's called a profit and loss. This means there's been every effort to collect a debt, and now the debt has been written off as a profit and loss. It is a loss to the creditor who issued it, and the customer no longer has any responsibility to pay that debt. Judgments are similar to a profit and loss. Judgments are when somebody hasn't paid their taxes. Most notably, it's tax judgments, but there's been a lien placed on the client's credit report, and it sits there until it's satisfied. There's been a court decision that the customer must pay the debt, and it will stay with them for quite a long time. There's debate on how long it will. And then the more catastrophic type credit events are short sales, foreclosures, and bankruptcies. Now, it's important to understand in Connecticut that we are what's known as a judicial foreclosure state. And what that means is it's very hard for lenders to foreclose on homeowners in the state of Connecticut. The state of Connecticut makes it very difficult for lenders. So as a result, it's not unusual that we saw this a lot coming out of the housing crisis, and it lasted well into 2018, where we would be looking at someone's credit and we would see that they had a bankruptcy and that they had a foreclosure. Now, what's important to understand is there's mandatory waiting periods from these. So let's just use an example. Let's say the mandatory waiting period on a bankruptcy on a conventional loan is 4 years, but on a foreclosure, it's 7 years. So we would say to our clients, okay, we see you have a bankruptcy. Did you have a foreclosure? Yes. And we would say to the clients, when was the foreclosure executed? And often, more times than you can imagine, the homeowner would say to us at the same time as the bankruptcy. And then we would have to go back to them and explain, no, that's impossible. There's no way your foreclosure was executed at the same time of your bankruptcy. And oftentimes customers thought their homes had been foreclosed at the time of the bankruptcy, and the foreclosure came several years later. So these buyers who thought they'd gotten far enough away from the catastrophic event of the subprime housing crisis, we're now basically, we've been in a position where we've had to tell people, no, you've got to wait even longer yet. So it's important that there's only 5 judicial foreclosure states in the United States, and Connecticut's one of them. So if you hear a customer tells you that they had a bankruptcy or a foreclosure, you want to have them call us right away, because you want us to iron out when those dates were, so that you don't wind up in a situation where we've got buyers who think they can buy a house and they actually still haven't met the mandatory waiting periods. Credit repair can make a big difference. Now, some lenders, not all lenders, we are one of the lenders that do offer something called credit. We can run something called a credit rescore, meaning if we see a client come in and their credit scores are not satisfactory, we can run a simulator that basically says, okay, we want to get this credit score to 620. What would the client have to do? Many times it's a very simple, inexpensive fix to get that credit score repaired, okay? If, however, there's no quick fix or inexpensive fix, then oftentimes we'll refer them out to a true credit repair expert to really help repair their credit. Now, there's a lot of like self-help credit score repair programs that people can buy, that they'll research on the internet. But I have to tell you, for as many people who've had success repairing their credit scores on their own, I've seen other people who've actually made it worse. There's some really strange things on credit scoring systems that if somebody's not savvy to it, they're actually gonna hurt themselves. And the most notable one is collection accounts. So collection accounts, when you have a collection account, you haven't paid a bill, and the collection account's been sitting there for a year, after 12 months, it no longer has an impact on your credit score. It's aged out. We call that aging out. And the longer you age away from a collection score, the less impact it has on your credit score. However, what most clients think is, oh, I know I have these collection accounts. Let me go in and pay those off real quick, and I know my credit scores will improve. But in actuality, that hurts their credit scores. because with collection accounts, it's date of last activity. So if it's timed off because it's just been sitting there, it's having no impact on their score. The minute they pay it off, the date of activity hits as today. Let's say it was today, and all of a sudden it comes up as a recent collection account and it drops their score. I had one client who did this with a $50 collection account. We were trying to repair her score. She did this without talking to us, and her score actually dropped 40 points as a result. So I always tell people this is one of the things that we want to definitely bring the experts in to help with. Certain little things you can certainly do to improve your scores, but you've got to be really, really careful. I want to talk to you about something that's really frustrating to many buyers today, and I'm sure you're hearing about it as well. So when a lender pulls a credit report, the credit repositories, not the lender, sells lists to other lenders who want to buy these lists to say someone has had a mortgage credit report pulled. So this is called a trigger lead. So when we pull someone's credit, they'll actually call us the next day and say, I don't understand, you sold our information. I'm getting 50 calls a day from these like insane, telemarketers to try to get me to use them for a mortgage. And we have to explain to them, it's not sold by us, it's sold by the credit repositories. The other issue is there's nothing that they can do about it at that point. The only way a customer can be sure, and there's a reason I'm telling you guys this, because you can help with this. The only way a customer can ensure that their information isn't being sold as a trigger lead is to request to opt out of those types of programs. Like it's consumer credit opt-out program. It takes about a week to 2 weeks to process the opt-out. So when we get a new customer who wants to be pre-approved, unless they're willing to wait two weeks to get their credit scores to have their pre-approval done, they're going to be sold out as a trigger lead. So when you start working, very early on with clients, I think it's a best practice for real estate agents to say, have you opted out of having your credit reports, your credit scores sold in the open market? And most people don't know it. So I've given you the phone number and the email, the website address that you could offer as a value to your clients, because these lenders that are calling as a result of trigger leads can create chaos in your transaction. They create chaos for us because, I'm going to be honest with you, they're not always the most reputable companies that are buying these leads. They provide a lot of misinformation. They can often razzle dazzle customer with what seems to be lower interest rates. Customer winds up, let's say, leaving a local reputable lender that you know and trust, and all of a sudden they're with a large internet company, and the whole transaction is very easily disrailed because of that lender. So it's in all of our best interest to make sure that clients are in the opt-out program so that they don't have this kind of chaos. And ever since rates went up, this has become even more onerous than it ever was. More and more companies are buying these leads because they need more customers, because refinance is dried up, and our customer, your buyers, your sellers, and our clients are being literally harassed, attacked, and really it's very, very difficult on them. So to the extent that you might be able to offer this as a service, to give them the information up front before they come to a lender, better off we'll be going forward. I want to say one other thing about credit before I move on to income. It's important to understand that when we're looking at credit, we don't just look at the credit score. Okay, we look at the body of the credit report. And occasionally there are things in the body of the credit report that will stop a loan from being approved, despite the fact that somebody has excellent credit. And the example that I want to give you about that is what we call disputed accounts. So I would say back in like 2015, 2016, 2017, credit repair companies were getting pretty savvy to the fact that if a customer disputed an account, if a credit account is in dispute, the credit reporting model takes it out of the model system. So for a couple of years, credit reporting companies were having clients put all their bad credit in dispute. comes out of the credit scoring model, and then clients were able to get approved for mortgages. Well, eventually, because of performance on those mortgages, Fannie Mae and Freddie Mac and FHA got wise to this practice and started looking in the body of the credit report for how many disputes there were. So today, when we go to run a loan, if through the automated underwriting system, if there's several disputes, we're going to be told in the underwriting findings, remove the disputes. Now, you remove the dispute, what's going to happen? They put it into dispute to get that piece of bad credit out of the credit score. You remove the dispute, their credit scores tank. So, making sure that the lender is really doing a good job evaluating the body of the credit report and not just glancing at a credit score is really, really important, because clients get caught on this all the time. Okay, income is, oh, I'm so sorry, I hit the button prematurely. Income, where credit demonstrates a willingness to repay, income demonstrates the ability to repay. Do they have sufficient income to meet their obligations? All right. Now, the way that we determine this is something called qualifying ratios or debt to income. Many realtors use the acronym DTI. What's their DTI? What's their debt to income qualifying ratio? Well, it's important to understand that up until 2000, we manually used a ratio of 28:36. And what those two numbers represent is this. What we basically said was their new monthly mortgage payment, principal and interest, taxes, insurance, HOA fees, all of that could not exceed 28% of their gross monthly income. Then we would take that proposed mortgage payment and we would add to that any car loans, any minimum payments on credit cards, student loans, all other debt that comes up on a credit report or that a client has. And then that ratio could not exceed 36% of their gross monthly income. There was an adage that went around for years. I still hear it once in a while from clients that basically said, make sure that your housing payment, your rent or your mortgage insurance is never more than 1 week's gross paycheck. That was kind of where the 28% came from, right? 25% if you're paid weekly. So that was the criteria. From 2000 until 2008, anything goes. We were seeing people, again, we didn't verify income, they weren't verifying employment, so there was no such thing as qualifying ratios. Today, in most loan programs, we're just geared toward what we call that back-end DTI. Up until 2000, it was 36. So today, what we basically feel is that under 38% is a conservative debt to income ratio. 38 to 43% is acceptable. And once we start getting to like 44% and above, I call that stretching. We're starting to really stretch someone's qualifying ratio. Now, what's interesting, guys, is that in the original ability to repay rule that Dodd-Frank issued, they were going to mandate that lenders would not be able to lend if the debt to income ratio was more than 43%. And when we do these classes in person, I've had some pretty robust conversations with realtors who, basically make the argument, rightly so, should we really be stretching somebody's ratio? Shouldn't we be making sure that we're lending responsibly and affordably? And what I want you to think about is there are times that it makes sense to stretch someone's ratio. So as I mentioned to you before, we have to look at employment, and we have to look at the type of income people are working. So it's not uncommon that somebody might have income actually coming into their household that we can't use in mortgage qualifying because of mortgage guidelines. So in that case, we're always comfortable if the profile of the client warrants it, stretching their debt to income ratio, because we know there's additional income in that household. And I think responsible loan officers and responsible lenders will be judicious in making sure that there's affordability there, because I don't know about you guys, but what the pain and suffering that we saw American families go through after the housing crisis and the subprime crisis, I would never want to see a family go through that again. So lending responsibly and making sure people can really afford their payments is really important. It's important to understand that the ability to stretch ratios is limited by other factors in the loan, such as credit score, and the other one is down payment. So we might be able to get someone approved with a 49% back end ratio because they're putting down 20% and they have a 740 credit score, and yet somebody putting 5% down with a 660 credit score, I can't get approved for more than 40%. That's not uncommon. So it's really important that lenders you're working with are running these scenarios through automated underwriting right up front at the time of the pre-approval. And many lenders don't do this because if they're just basically running the numbers and thinking they're okay, they're not going to get picked. They're not going to pick up the fact that the automated underwriting system may have an issue depending on the layered risk of that client. It's really important, I mentioned this before with income, really important that we demonstrate a history, that they've had a history of receiving this income, and that it's going to continue, okay? So history and continuance play a really big part in income and employment. So what type of,
in the chat?
yeah, please.
There's a question in the chat. Asavari is asking if it is gross household income or individual. I'm not.
That's a great question. So when we're evaluating it on a mortgage, it's gross income of anyone who's on the mortgage application. So it's not uncommon, let's say that we get a couple in and they're applying for a loan and one spouse has excellent credit and maybe the other spouse doesn't, and that lower credit score could impact the ability to get the loan. So in that case, we take that spouse who has the poor credit off the loan, and then we're forced to qualify them only with the other spouse's income. So it's all about who's on. We can use income from anybody who's on the loan. And that would include, guys, something like non-occupant co-borrowers. Mom and dad have decided to co-sign, you hear this a lot. The mom and dad have decided to co-sign and help the kids qualify for the property. So mom and dad go on the mortgage, we get to use their income and qualify them as well. I hope that helps. And again, please don't hesitate to interrupt me because, I get sick of hearing my own voice after this much period of time. So I would love to have open dialogue and conversation with any questions you might have. Is that a new one or is that the same one? Oh, you're welcome. Okay. What types of income can we use on a mortgage application? Well, obviously we can use employment with the caveat that we've got to see that they have a 2-year history of receiving employment income. It does not mean they have to be in the same job for 2 years, but they have to have been adequately employed for 2 years. So you can imagine that after the pandemic, when so many people had employment furloughs and gaps of employment, we were doing a lot of work trying to problem solve for this because there's guidelines on how long a gap can be in order to use certain types of employment income. So again, employment certainly reliable. Now, if you have someone who's just coming out of college or just coming out of trade school and they've got their first job, we do consider education as a history. So someone coming out of college or just entering the workforce for obvious reasons, we're able to use their employment if they've got education that backs up them going into that field. So that's really nice that's a really nice feature. We use second job income, not uncommon today for people to have second jobs. They do, in this case, have to have a 2-year history of working 2 jobs. So oftentimes I'll have somebody come to me and they'll say, okay, I just got a new job because I wanted to help me qualify for my loan. And that's not allowable because the fear is they don't have a history of it. They're going to come in for a second job to get the loan. They're going to quit the second job. And now they don't qualify for the house without it. Commissions and bonuses are acceptable sources of income. Again, we need to see a 2-year history and we need to verify that it's going to continue. We verify continuance on commissions and bonus through the employer. We require the employer to state that it's likely to continue. Obviously, we use business income for self-employed borrowers. Again, 2-year history. We use rental income. And rental income, if somebody just bought a new investment property last year, there's ways that we can use that rental income. So that's certainly, there's a lot of guidelines around acceptable rental income depending on when they purchased the property. But ordinarily with business and rental income, we're going to be looking for the tax returns that verify that income. Alimony and child support as income are acceptable. Couple of caveats on that. We have to prove that that's going to continue for 3 years. So whenever somebody tells me they're getting alimony and child support, we have to see the divorce decree. If they've got twins who are 16 years old, we're not going to be able to use the child support, because in the state of Connecticut, even though divorce decrees may indicate otherwise, mandatory child support goes to the age of 18. And we need to always verify it's going to continue for 3 years. So 16 years old, we're not going to get 3 years to 18. We wouldn't be able to use that income to qualify. And then we evaluate the divorce decree relative to any restrictions or terms or conditions on how they receive the alimony payments. Certainly, if you have people who are receiving interest and dividends, we use that income. Social Security and disability income is acceptable. Again, we can often use that if it's been recently awarded, not necessarily having to have a 2-year history because it's a permanent award. So that tends to be a great way. And retirement income. There are some really cool guidelines, guys. Like when we're having a struggle qualifying somebody, depending on their age and if they've got large amounts of retirement income, we can actually assign out some income, even though they're not taking retirement income yet. We can assign retirement income out to help them qualify, and they don't even have to set up a distribution or anything. So some really cool things we can do if we've got a borrower who's struggling to qualify but has large retirement assets. This is so interesting that this gets stuck sometimes. Here we go. All right, so we've talked about this, stability. We've talked about all this: history, continuance, multiple jobs, part-time jobs, self-employment. Those are the places where most notably we're going to be looking for those two things. Now let's talk about that debt to income qualifying ratio. Okay, when we're looking at debts, we're going to be looking what's going to be counted in that debt to income ratio. We're going to be looking at any other mortgages that the buyers have. We're going to be looking at auto loan payments, auto lease payments. We're going to be looking at the minimum monthly payment on credit cards and personal loans. Where we see a lot of difficulty sometimes qualifying buyers is when we're looking at student loans. A lot of clients, especially with the pandemic and the free forbearance that took place, if somebody has student loans that are in forbearance, we still have to take a minimum payment, and it's a percentage of the balance of the student loans. Just because they're not making payments now doesn't mean they're not going to have to make payments. And so as a result, we have to allocate a payment. Now, we do a lot of digging. We do a lot of digging when we see credit reports come over with a lot of student loans, and it's common today that people have hefty student loan balances. We'll basically ask, who's making let's say it's a young couple, who's making the student loan payments? Are you making them, or are your parents making them? If they tell us their parents make the student loan payments, but the payments also happen to be in their name, we can get 12 months canceled checks or 12 months bank statements to prove the parents make the payments, and then we don't have to count it in their debt to income ratio. Similarly, if we're doing a loan for parents and we see a lot of student loans come up, and this isn't uncommon, who's making the loan payments? The kids are making the payments. Same thing. We'll get evidence that the kids have made the payments on time for 12 months, and we don't have to count that against them. All right. The other thing we do, and we actually have a program that we work with to help people do this, is a lot of people qualify for what's called income-based repayment, meaning depending on their field in which they work and depending on their income and their student loan balances, they can sometimes qualify for federal student loans into what's called an IBR program, where every year the government evaluates what their income is relative to their balances and assigns out a new payment. And after a certain period of time, typically 10 years, whatever balance is left at that point is forgiven. This is usually available to medical professionals, teachers. Professions, the government put this in place to get people to come into professions where there's a shortage of help, but perhaps the income is is lower than what the cost of education is. The most famous example I ever saw was I was doing a loan for a young couple, and the wife was a social worker, and she had financed her private education at the University of New Haven, bachelor's and master's, all on federal student loans. Her student loan balances, when I talked with them the first time, were $250,000, and her income was $40,000 a year. I mean, she was devastated because what we finally had to do, she didn't qualify for an income-based repayment program, is that we had to take her off the loan and just qualify her husband alone, because there was no way her income could keep pace with the amount of student loan debt she took. So a lot of kind of issues that we see sometimes around student loans. Does anybody have any questions on that? Okay. Have I kept you awake? Because I can't see your faces when I'm presenting, so I'm hoping everybody's awake.
Yes, we're awake.
Good. Good. All right. Assets, right? So, do you have the money to buy a house? And what assets demonstrate is what we call fiscal responsibility. So the reason I didn't do subprime loans, and I was a little bit of a laughing stock back then because I wouldn't do them, is I remember sitting in front of a young couple. They had 2 babies in car seats or in strollers meeting with me. They had poor credit. They didn't make a lot of money. They were paying $1,000 a month in rent. I think it was $1,000. And they wanted to buy a house with a $2,900 mortgage payment. And they hadn't saved any money. And I just remember having this honest conversation with them. And I said to them, look, subprime lender will lend you money. I'm not going to lie, but I can't do it. I can't do it because you're making $1,000 monthly mortgage payment. Rent payment, $1,000 rent payment. You haven't been able to save a dime based on that. This is where asset evaluation comes into place. And yet you now want to almost triple your housing payment. They were very offended. They did go down the street to a subprime lender. They were friends of a good realtor friend of mine who referred a lot of business to us. The realtor certainly understood. And that family called me 5 years later. They had lost everything. Of course, their house went into foreclosure in the subprime mortgage, debacle. And the wife said, we should have listened to you. We absolutely should have listened to you. So I just bring up that story because there's an expression, a clear conscience makes for a soft pillow. I just could never understand. I would plead with people, and I still do to this day. Look, here's the challenges. Tell me how you're going to be able to afford this. I know you really want this house. I know, we're struggling to get you qualified. Tell me why. And oftentimes what I'll do is I'll look to, have they been able to save money? Okay. Have they been able to put money away? And if they haven't, it's not, I have on occasion suggested to people, here's what I want to suggest you do. I want to suggest that for the next 4 months, you put the amount of money aside, save the amount of money that this new mortgage payment's going to be, and see how comfortable you feel. And it's a great fiscal exercise for buyers who are really struggling to qualify, to help demonstrate to them what their life will look like with a higher mortgage payment if we're able to get them qualified. So it's, there's a lot about fiscal responsibility, and it goes both ways. So we're going to always be looking at the first thing we're going to always look at, what's the borrower's own funds? How much have they saved in their bank accounts? How much have they put away in retirement accounts? What other types of assets do they have? And typically we're going to want to see that they've had this for 2 months. And any large deposit that we see over a 30 or 60-day period, any large deposit into their account, we're going to have to verify. And if they can't verify it, we have to back it out. We can't use it. So it's, we've had cases, I'm just thinking of cases in the most recent year. We had someone who sold a car. We saw like a $19,000 deposit in their account, got a copy of the bill of sale, and we were able to document that was, and a copy of the check from the buyer of the car. So we were able to document that transaction. Other times people say, well, it's just cash. It's just cash I put in the bank. Cash. There's some places that we can work with true cash on hand. and there's a lot of places that we can't. So when we're talking with someone who's got cash, and I want to be honest, there are certain cultures, you know, as multicultural lending becomes more and more prevalent in America, largest growing population of first-time home buyers are Hispanic borrowers. It's not uncommon that other cultures have a mistrust of banks and keep a lot of cash in their possession. So there's ways that we'll counsel those families on how to work with the cash that they've saved, and there's loan programs that will allow it, and there's others that won't, and we usually always have a strategy on how we can handle that. Gift funds are available from family members. Actually, this guideline recently changed at the end of last year, that if we can establish a close personal connection to, let's say, a very close family friend, we can now consider gifts from close friends, but typically it's always been from family members. And then the other place that we can pick up assets, which has not been popular since the pandemic, but it will be again, and I think it's a strategy that, you know, everybody needs to understand, and I'm gonna go through an example of this at the end of the presentation today, but is seller paid closing costs. So if we've got somebody who's struggling, you know, because they don't have enough money for down payment and closing costs, we can look to the seller to pay some of those closing costs. And the general rule of thumb that I like to tell everybody, because they'll say, well, what's the percentage? And, you know, you can't run a certain percentage overall. So I tell everybody, figure $5,000 for lender fees. They're going to need 14 months of homeowners insurance up front. And typically they're going to need 9 months of property taxes. Those are your closing costs. I mean, when customers call us and ask us what their total cash to close is going to be, this is the evaluation we use. You know, and again, as inflation hits, I would say, I actually want to change the slide. It's probably closer to 6,000 in closing costs now. Lenders have been forced to increase their fees since the pandemic. So that's the calculation. And there's limitations and restrictions on how much the seller can pay towards closing costs, depending on the loan program, but really, really solid way to help buyers get into a property. Obviously not popular in 2020 and 2021 at a time when every house that went on the market, we're still seeing it now, of course, in 2020, 2021, 2022, where houses go on the market, there's 20 offers on the house, seller doesn't really have to feel motivated to contribute towards their closing costs. But when you're using this strategy, I'll always turn back to you, the realtor, and say, what do you think this house will appraise for? Because if the house is going to appraise well, it's not uncommon that let's say you have a customer who's going to offer $250,000 on a house, and they need $10,000 in seller paid closing costs. I'll have a conversation with you and say, is there a chance this will sell? This will appraise for $260, because if it is, we can put this deal together, go in at $260, tell the seller to pay $10,000, seller's going to net $250, which the original offer or agreed upon price might have been, and yet now we've got money to be used towards closing costs for the buyer. So really phenomenal strategy. Before the pandemic, I would tell you that most first-time buyers contracts we were recommending and seeing done with seller paid closing costs. I'm going to peek at the chat. Sherry. Oh, that's so great. I was just thinking about this with the cash on a personal reason, but okay.
Yeah, no, I was just thinking this yesterday. I mean, it's just, and I keep coming across it where people, they have a lot of cash, and I mean a lot of cash.
Oh yes,
but
I
it's
know.
like over many years they just save a little bit, and like I have their old Hungarian and Italian family members, and it's not uncommon when they pass away, you see their life savings is under the, it's real, it's nothing illegal.
No,
but how do you?
Yeah,
it's concerning because now they're trying to digitalize everything.
It is.
And what do you do?
We see it a lot. I'm not gonna lie, we see this all the time. So if we can, so let's not think about the inheritance piece. If we can demonstrate, like the one I did most recently was for a waiter. Okay, so we had a waiter, you know, obviously doesn't show a lot of income. we were able to qualify him with his income, but all of his down payment was tip money in cash. All of it. We were able to get an underwriter in a particular loan program to approve it because it made sense, right? It makes sense that a waiter would have a lot of cash on hand. We've been able to demonstrate. I had a Hispanic couple last year that we did where we were able to demonstrate they got direct deposit into their paycheck, and after every paycheck, we saw $500 come out. And when you added up that $500 over the length of time we verified it, it was equal to the cash that they had in their strong box. So there's ways that we can work it. Obviously, the people who've been sitting on a lot of cash for a long period of time, it gets a little bit harder. And like there's strategies. I mean, this is why you want to work with a really good lender, like somebody who knows how to lend. So let's say somebody's got $50,000. They wanted to put $50,000 down, and maybe that would have been equal to 10%. And I can maybe verify a bit of it, but not all of it. What we would often then do is recommend that they borrow a higher amount, not put that all down, close on the loan, and then after closing, they can always make a principal reduction on the loan. And at that point, the lender's not looking at where the funds came from. So there's a lot of different strategies that we can employ to help people in this situation.
What if they're retired and that cash is their retirement? They don't have the proof of income.
Yeah, that gets harder. Yeah, that gets harder.
Yeah.
Yep.
Yeah, I was just thinking, I'm like, I got to come up with strategy on this because I know I mean, I just got my license in the spring, and I've had more cash people, like lots of cash people.
I know.
Than I've had common. Anything.
It's common. Yeah. And we saw a lot when the pandemic hit, like when we had the shutdown in 2020. We saw a lot of people, and this was easy to verify, but we saw this a lot. Would go to their bank, take out all their money. They would take out everything, put it in cash on their premises, and then they were going to buy a house. But we could go back to like the day where they took all that money out of the bank. So it really depends on the situation, the overall qualification, but we usually have it. It's also not uncommon if we have someone, in this situation, we'll say to them, look, you're going to have to get this cash in the bank, and it's going to have to season. We call it season. It's going to have to season there for anywhere between 30 and 60 days, depending on the credit profile of the client. So we'll see that a lot,
So
we'll absolutely
maybe the advice would be like when somebody says, because they tend, I mean, at least I see you always ask about pre-approval, so they tend to tell you if they're cash.
Oh yeah.
And so just immediately, like in the same time as starting to search for a house, start talking to a lender and figure out how we're going to present this cash. So we have like a game plan.
And sure, that's where you're going to hear me say this over and over again. That's where talking to a good lender, it makes the difference, because there are lenders that will issue pre-approval letters and never ask where the assets are coming from. They won't ask. Now you wind up where you get a client into contract, they've paid for the home inspection, they've paid for the appraisal, and all of a sudden they're getting turned down because everything's cash on hand and there's no way to document it. It's really important that, and this is most notorious with online lenders, because they aren't, the people who are taking the applications online and over the phone aren't trained in lending, right? They're just customer service people who are putting information into a system. If they're not asking those deeper questions like, oh, how much money do you have for down payment? I have $50,000. If they don't ask the next question, where's the because I'll say to them, where's the 50,000? It's in the bank. And then I ask the next question, how long has it been in the bank? Because it's also not uncommon that people who are preparing to buy a house who've been sitting on cash before they come to me, plop it all in the bank. So you've got to work with somebody who knows to ask these higher lending level questions so that you don't get caught. These clients, and it happens all the time, these clients don't get caught where they're in contract on a house and now they have no down payment, essentially, because the lender can't work with it. So really important, really, really important. It's a great point. It's a really great point. We're seeing more and more and more of it. Gosh, it's so funny how my computer, there's such a lag in getting this. Here we go. All right. Let's talk about your favorite subject, the property, right? So one of the key criteria that we're going to look at is what's called loan to value. And the loan to value ratio is one of the most important things that we look at as lenders, right? And the loan to value is the loan amount, the purchase price minus the down payment equals the loan amount divided by the purchase price. So if you are working with a buyer who's putting 5% down, I have a 95% loan to value. If you're working with a buyer who's putting 20% down, I have an 80% loan to value. So realtors talk in terms of percentage of down payment, lenders talk in terms of what's called loan to value, okay? Really important, and if many of you sold houses in 2020, and 2021, 2022, real important to understand that our loan to value is based on the purchase price or the appraised value, whichever is less. So for example, the most common, conventional loan, let's say requires 5% down or 95% loan to value. In the height of the market, if a property underappraised, because everybody was going over asking price, if the house underappraised, and we saw a bit of this, especially in the beginning, and they were putting a minimum down payment down, we're now basing that minimum down payment on the appraised value. So we're only going to lend them up to 95% of that. And then they have to come up with the difference between the appraised value and the purchase price. So for people with small down payments, the pandemic was a difficult time for purchasing properties because of what we call low appraisals, all right? Whenever a customer is putting less than 20% down, they are required to have what's known as PMI or MI or mortgage insurance. In the mortgage industry, we love to have 3 or 4 acronyms for the same thing. It's so confusing, but they always have to have PMI. I will tell you that there is a revolt and a revolution going on in America today. Millennial home buyers hate PMI. They hate PMI. I've been doing this for almost 40 years. PMI has been around for as long as I've been lending, and I've never seen the negative reactions to PMI that I've seen with today's millennial buyers. We've got some strategies for that as well, but just kind of important to know that going in. You'll hear people say, well, I don't want to buy a house until I have 20% down because I don't want to pay PMI. And then I have to do a financial demonstration to them about if the house continues to rise 5%, how long do you think it's going to take you to save 20% down? 4 or 5 years. Okay. Well, if this property that you're looking at today continues to appreciate at 5% a year, you're going to pay an extra, whatever that number is in dollars, in order to save, in some cases, as little as $25 a month in PMI. So there's a lot of conversations and comparisons with clients and buyers who are really, really stuck on the PMI issue. There's also ways to also finance the PMI so that essentially they don't see it every month. And that's been a strategy we've been employing more and more since this phenomenon kind of seems to start taking place. Really important to understand that appraisals are done based on comparable sales analysis. And the appraiser has to look at comps that have sold in the last 6 months. This is the explanation why early in the pandemic and why, well into 2021, the first quarter of 2021, I think is when it got really bad because again, property values were going up at record pace. People were coming in over asking price, and the comparable sales couldn't keep up. And so, I'd have to have some conversations with realtors about like, where is this going to comp out? Forget what the market's bearing right now. We have to be concerned about appraised value. Where is it going to comp out? On the 18th, on January 18th, the association is running a program called Real World Strategies for Real Estate as part of our RAMP real estate training program. And in that training program, there's a speaker who's going to speak. Her name is Stephanie Paul, who is, in my opinion, one of the best agents I've ever seen. able to evaluate comp analysis. So we're bringing her in to teach people on how to really do a good job evaluating comps, because it's not uncommon. I would ask a realtor over those couple of years, where do you think it's going to appraise? And the realtor would say to me, I have no idea. You know, it's problematic, because if we're trying to put a deal together, especially if we're dealing with a customer who's got low down payment, that's problematic. Also important to understand condition, right? We as a lender have responsibility and liability relative to this transaction. So we're not going to let anybody close if we feel that there's any safety issues in the property, okay? So just, again, that shows up in a lot of different ways, and we'll go into that a little bit more shortly. Yay, thanks. That's a great idea, Rach. Thanks for putting that in. All right. Let's talk about the difference between pre-approval and pre-qualification. As I said to you before, not all lenders conduct business the same way. So you can have a lender issue a pre-approval letter. I had this happen last year, like summertime of this past year, from Citibank. I don't mind calling them out. Citibank, one of the largest banks in the world. Client was issued a pre-approval letter, went into application, got turned down because they never pulled his credit report before they issued the pre-approval letter. Not all lenders conduct business the same way. For example, at Prime Lending, we believe that a true pre-approval is when a loan has not only been vetted by the loan officer up front, because your pre-approval or pre-qualification letter is only as good as the loan officer working it up. I want you to understand that. So Prime Lending, we don't believe we should be using the term pre-approved for fair lending reasons unless you've actually been put into underwriting. All right. So during the pandemic, when business was slamming and there were not enough underwriters in the world, all of our letters went out as pre-qualification letters. Now, I would get calls from some agents who didn't know me, and luckily we're pretty well known in the marketplace, and they'll say, well, this is a pre-qualification letter, it's not a pre-approval. And I'd say, no, but let me tell you what I did to pre-qualify them. You know, I pulled credit, I evaluated all the documentation, I ran it through automated underwriting. I can guarantee you, and this is why our letters kind of have become, whether they're called a pre-qualification or a pre-approval, like the gold standard, that most realtors who know us know that regardless as to what it says on the top, we have properly vetted and worked up this loan application accordingly. Once interest rates went up and going into 2022, and all of a sudden underwriters had more time, we now put every pre-qualification client into underwriting so that we can issue a true pre-approval. And that's been so important for us, because like in a multiple bid situation, it's been very gratifying for me to be able to call a listing agent who does or doesn't know me and say, hey, I just want to let you know, they're completely approved. All we're subject to on this loan is a contract and an appraisal. And in some cases, guys, we don't even need appraisals right now. So if that happens, it's just very gratifying for a listing agent to hear this has already been through underwriting. There's no outstanding conditions. This is going to be smooth sailing. So that's been a really wonderful enhancement to the mortgage lending industry over the course of 2022. A lot of lenders still aren't doing this. I'm thrilled that our company is, because it gives our clients a competitive advantage. Also, a general rule of thumb, when we've got clients who are really trying to drill down on affordability and what their monthly payment is, you know, general rule of thumb, and this has changed a little bit since rates went up, but what I always tell people, we're like, okay, can you run the numbers for me with a $200,000 mortgage? Can you run the numbers for me if the mortgage is $201,000? Can you run the numbers if the mortgage? And so what we'll say to people is, as a general rule of thumb, $10,000 in financing is equal to between $50 and $60 a month in your payment. So that works in a couple of ways, right? So if you've got a client who's really not sure they can afford to go up $10,000 in their list price, because they don't understand the impact that that's going to have on their monthly mortgage payment, using that $50 a month rule of thumb is pretty helpful, because you can say to the customer when you're trying to come up with their negotiation and what they're going to offer, if they're really hedging because they think $10,000 in additional financing is going to break the bank, well, it's about $50 or $60 a month. Do you think you can afford that? So that's a nice rule of thumb for you guys to have. Okay. I just want to make sure that wasn't a question. Is that helpful? All right,
Yes, thank you.
good. Thank you. I'm just, well, again, there's this lag on my computer for some reason, moving the slides. I've never had this before. Okay, here we go. All right, so we're going to go through this pretty quickly because, you know, again, you want to rely on us as a lender, but I want to go through some of the programs with you so you have a kind of a working knowledge of it. We have conventional loan programs. These require good to great credit. It's a 620 minimum credit score. They can't go under 620. If you have a first-time home buyer or someone whose income is what we call in a restricted amount, like under a certain amount each year, they can usually get in with a program that requires as little as 3% down. Otherwise, if they're not a first-time home buyer or they're not, their income doesn't qualify for the program, they're looking at 5% down. The maximum amount of seller paid closing costs is 3% of the purchase price. So when you're looking at potentially having the seller pay, always going to be really important. You check with your lender to make sure you understand what loan program there are, because you don't want to negotiate, you know, a nice, big, enormous, huge seller concession only to find out it's in excess of what they can actually get, make the whole transaction kind of go sideways. There are tighter ratios, especially when we're dealing with credit scores under 680. And today we can lend up to $700,000 for a single family home on these conventional loan programs, and even higher loan amounts for multifamilies. That was big news. And I used this piece of information. I use this a lot when I'm talking to people about whether we think property values are going to go down. I mean, the government increased the conventional loan balances by $70,000 this year, year over year. It's the largest increase in history. I mean, it's got to tell us that the government really believes property values are going to hold and continue to grow, albeit not at the pace they were growing at, but really no concern, because otherwise they wouldn't be lending up into these loan amounts. FHA loans, government loans, fair to great credit. You can go down to 580 credit scores with restrictions. They do mandate a 3.5% minimum down payment. They will allow us to go with 6% seller paid closing costs, 6% of the purchase price. They are much more flexible on the debt to income ratios. They are a bit stricter on property conditions. So if you're working with an FHA buyer, a buyer who's been pre-approved for an FHA loan, and this is a really important loan program that we use in America today, and you're out looking at properties, the first thing you want to be looking for is peeling paint. If you see peeling paint on the interior or exterior of this property, I'm going to tell you right now, the appraiser is going to come back and mandate that the peeling paint be taken care of before closing. And we have a lot of other solutions for those types of issues, but peeling paint is kind of a number one culprit. Second type of thing we often see coming back on appraisals for property condition is a missing handrail on stairs, anything that's like safety minded, a missing step on a deck. And we're not going to, FHA won't allow us to close that loan unless they know that all of those things have been repaired prior to closing. All right. Another big thing about FHA loans, they're assumable. So you think about all the clients that are walking around in America today with an FHA loan where the rates are like 3%. When they go to sell those houses, although the mortgage industry hasn't solved for this yet, there's a likelihood that they'll be able to pass that 3% mortgage onto another qualified buyer. The reason we haven't solved for this yet is because you need what's called gap financing. Customer bought a house for $250,000 with 3.5% down. 5-10 years later, they're selling it for $325,000. Rates are at 6%. They're sitting on a nice low 3.5% interest rate. Where's that extra money going to come from? And that typically has to come from a second mortgage program. And those programs currently don't exist, but the lending industry is working hard to come up with gap financing. It's just interesting to know that they can do that. And again, max loan amounts. This was a really big improvement as well, because in New Haven County last year, we were limited to about $350,000. So there were a lot of people we wanted to use the FHA loan program for because it would help them qualify, only to find out that it was the loan amounts were keeping us back. I'm going to start talking fast because I can't believe how fast the time goes. VA financing for veterans, 100% financing. Okay. All the borrowers must be a veteran or married to a veteran. I'm going to tell you right now, twice in my career, I have had young couples who are engaged, want to buy a house before they get married, go to town hall, secretly get married so that they could get VA home loan financing, and their parents never knew at the time that the real wedding took place. Hysterical. They're more flexible on ratios. Very important loan program for our veterans, okay? Another popular loan program is CHAFA, the Connecticut Home Financing Authority. This program's got a lot of publicity recently because they've been offering down payment assistance grants. So you can typically borrow up to 105% of the loan amount, which would include down payment and some closing costs. The only thing I'll say about CHAFA is you must be a first-time home buyer, which is defined as not owning a home within 3 years. They are very strict on debt to qualifying ratios, and you will never be able to retain that home as an investment property. So when I'm looking at CHAFA loan programs, I'll always say to a client, do you see yourself selling this, or like many other buyers today, are you thinking you would want to keep this and rent it? Because if they want to keep it and rent it, we don't want them in a CHAFA program. You have to retain CHAFA for owner occupancy throughout the life of the loan. USDA, we don't see a lot of this in Connecticut. There's some parts of Durham, up in Middlesex County, we've got some parts, but it's 100% financing for rural areas. The funds are approved by Congress each year, and it's not uncommon for the funds to run out. Jumbo loans are loans, this is actually, I didn't change this is actually for loans over 700,000. They're very strict today because they have additional ability to repay requirements because these loans are not sold to the government. Loans being sold to the government have a little bit more flexibility on that ability to repay, but jumbo loans don't benefit from that. Completely different guidelines. So if you're working with high-end borrowers, you want to be sure that your loan officer is very well versed on how to do a jumbo loan because there are completely different underwriting guidelines. Renovation loans, this happens to be one of my favorite types of loans. Not a lot of loan officers do them, and certainly the ones that do often don't do them well. It happens to be a specialty of mine. It allows renovation loans is one loan that you can use to remodel and renovate properties, typically owner occupied properties, okay? It became very popular with millennials because they're watching HGTV and they want houses their way. The story I always tell is that my daughter wanted to buy her first house and her criteria was nothing had to be done to the house. She buys it, we find a house, she buys a house that fits that billing, nothing had to be done. Now she starts watching Joanna Gaines every Sunday. And next thing I know, she's ripping out the kitchen, she's ripping out the bathrooms, and she wants it completely done over farmhouse style. So a lot of things we've been able to do. I would tell you right now in this market, we've seen it as a solution to the inventory crisis. Last year, I did a renovation loan for a client who wanted a colonial, couldn't find a colonial. He bought a Cape using a renovation loan, and we converted it to a colonial. You know, some of the properties that are sitting on the market right now for a long period of time that aren't getting multiple bids and multiple offers have things wrong with them. Renovation loans can solve that. So I would say to you, if you're working with buyers who are getting frustrated or whatnot, always worth a great consultation call with me because renovation loans done well can really make a difference in today's marketplace. All right, let's talk about mortgage rates because this is the thing everybody wants to know about. So there's a lot of hysteria in the market right now about where mortgage rates are. And I have found over the last 9 months since rates started going up, especially with millennial buyers, who we know is the largest age population of buyers in American history, and certainly represents the largest amount of first-time buyers in America today, that age group, millennial buyers. They don't care that interest rates prior to the pandemic were at 5 or 6 or 7%. They don't care what the historical context is with interest rates. And that is the truth. During the height of the subprime era, when we had the biggest explosion of real estate sales and real estate property values going up, rates were 6.5%. And then very exciting in like 2008, they dropped to 5%. And we did a lot of refinances. The rates that we experienced during the pandemic were artificially low interest rates, driven by the Fed's concern that the global pandemic was going to create economic uncertainty. And there's a lot of debate right now and a lot of great conversations going on about how the Fed probably overshot this, right? They brought rates down perhaps too low. It created the demand and the issues that we're seeing in the real estate market today. And when they had to come back and start adjusting interest rates, okay, there's been a real backlash. What's so important for you to understand is this: whittling all this data down, here's what I want to tell you. Mortgage rates follow inflation. So you would have to be living under a rock right now to not know that right now the Fed's biggest issue is fighting inflation. As a result, the way they fight inflation is to raise rates. So every time the Fed has a meeting, everybody, all the media picks up the fact that the Fed is raising rates, the Fed is raising rates. The Fed is only raising rates until it gets inflation in check, okay? Once inflation is in check, what will the Fed do? They'll start lowering rates. And at that point in time, mortgage rates will come down. Just like during the pandemic years, mortgage rates were artificially low. Mortgage rates today are artificially high. Without the issues of inflation, mortgage rates today would probably be somewhere between 5.25% and 5.5%. And the expectation is that sometime either in mid to late 2023 or early 2024, when the Fed gets inflation under control, and they will, mortgage rates will come down. So every time I talk to a millennial buyer today, or any buyer really for that matter, I don't mean to be like putting this all on millennials, I'm demonstrating for them what today's rates are, what their payments are today, and what it will look like if rates go down to 5.5%. Because this is only the second time in my very long career I can say with certainty, we know mortgage rates will be coming down within the next 24 months. And that's provided a lot of assurance and increased people's comfort level with kind of the original hysteria that we saw coming when the Fed started raising interest rates. Should we wait to buy? Is there going to be a bubble? We're waiting for the housing market to collapse. Whenever a buyer says that to me, we're going to wait to buy because we know property values are going to come down a lot. I'll say to them, what makes you think that? And what makes them think that is a couple of things. One, they know about the housing crisis in 2008 through 2000, in Connecticut's case, through 2018. And the media is out there, obviously, creating a lot of fear and hysteria. So this is an example of just one news outlet who in 2015 said that there was a bubble. Excuse me. In 2015, they're quoted as saying there was a bubble larger than 2006. And you could see each year they were saying that. And correspondingly, excuse me, guys, here's the rates of appreciation on a national level over those years. So if somebody was listening to the media in 2015, waiting for the bubble, and they didn't buy until last year, their $315,000 house is potentially worth $522,000. I use this chart a lot when we're talking to buyers about how they should be evaluating buy now or buy later. And I think it's pretty compelling. I'll get to this in a minute. Connecticut's a little bit different. I saw some stats this morning when I was reading the paper. The median home price in Connecticut for 2022, $345,000, up 7%. Listings in Connecticut on average sold for 2.4% over list price. And Redfin is basically listed in their top, I think it was their top 20 US markets who are best positioned to not have home price depreciation, Hartford County and New Haven County, Connecticut. So what I want you to understand about the Connecticut real estate market in particular, relative to the appreciation we've experienced over the last couple of years, it's important for you to know that every year, Freddie Mac publishes home price appreciation by state. And from 2008 until 2017, Connecticut ranked dead last. And what that meant is that Connecticut was literally ranked 50th for coming out of the housing crisis with home price appreciation. And back then, if you were in real estate, there was a lot of talk about why Connecticut was suffering. We were losing most of our a lot of our wealthy population. We were losing unfunded pensions. There's a lot of reasons why Connecticut was struggling so much with property values. But the point of the matter is that we ranked dead last. We only started to experience appreciation in 2018. Now, I want to tell you that's in direct contrast to other parts of the country, most other parts of the country. Through 2008 and 2020, most other parts of the country had already experienced home price appreciation. So are there parts of the country that are probably going to see some reduction in home prices over the next couple of years because they were hot to begin with, and then they got hotter after the pandemic? Yes. But the reason Redfin is ranking New Haven and Hartford County as being well positioned to not have that is for the very reason that I've just explained to you. We did not experience home price appreciation. Going into 2018, less than 50% of the cities and towns in Connecticut had regained pre-housing crisis levels of value. So I actually firmly believe that in Connecticut especially, we're really well positioned to be holding these values, to not necessarily, we're not going to continue to see 7% appreciation like we did in 2022, but certainly something more of the norm, 3%, 4%, 5% home price appreciation probably over the next couple of years. So that's my 2 cents and my evaluation based on all the data that I was evaluating all those years in between. And because I work for a national company, all my counterparts who worked around the country were experiencing all this great rebound, 2010, 2011, 2012, and we were sitting here in Connecticut like frustrated and depressed over where our property values were. So as we're coming out of the current market conditions, and we know that the Connecticut market is still very robust, especially for well-priced homes, if you are in a position where you have a listing that for some reason isn't selling and you are thinking about taking a price reduction, and we're seeing a greater percentage of houses on the MLS taking price reductions right now than we have over the last 3 years, I want to suggest an alternative to you to present to your sellers. So if you believe that the property would appraise out at the listed price that it's at, our recommendation is to consider using what we call a 2-1 buy down. And what the 2-1 buy down does, I don't know if this is covering, okay. What a 2-1 buy down does is temporarily lower the interest rate for the buyer on the property. So the example I have here, and guys, I'm going to be emailing you all this presentation after. I should have told you that up front. You're going to all get copies of this. So this chart, if you want to really digest it, you'll be able to digest it and look at it as a potential for maybe keeping some strategy together. So the reason we're recommending this is because we know that buyers today are worried about interest rates. All right. So if you have a house that's listed for $350 and you believe it will appraise for $350, just thinking about reducing the price $10,000 for whatever reason. Okay. $10,000 price reduction in this case this was done with interest rates at 7%. Will save the buyers about $68 a month in their monthly payment. Going back to that $50 rule, right? Depending on where interest rates are, but let's call it $68 a month in their monthly payment. Nothing too exciting. Certainly that seller is not opening the door to more potential buyers by any stretch of the imagination by only improving their the buyer's position by $68 a month. However, if we use a 2-1 buy down, the cost of that program paid for by the seller, preserving the listing price at $350, is $7,484. Now, in this case, seller's not dropping it 10. Instead of dropping the price 10, they're going to invest $7,484, and the buyer is going to get the first year. This was done at 7.25. First year, 5.25% interest rate. Second year, 6.25% interest rate. Third year, 7.25. This is going to save the buyer $418 a month in the first year, $205 in the second year. And by the third year, based on the fact that I just told you rates are going to be coming down, they likely would have refinanced. This is a phenomenal program to really help sellers induce buyers if and when the market starts to come down and you have to start thinking about taking price reductions. Now, one of my friends who's a great agent who sends us a lot of business said to me, yeah, but the drop in the price is going to trigger in the searches. So she and I came up with the idea, well, drop the price by $1, drop the price by $1,000, whatever the case may be, so that it triggers the online search, but promote the fact in the listing that the seller is going to be able to save the client 2% on their interest rate in the first year. Okay, so this has been a really great strategy we've been using, again, in this market where people have been worried about where interest rates are. As you know, interest rates are not at 7.25% right now. They're running more in the like 6.5% range. This is where the highest they got to, and then they came down. But everything we always look at is like, what if they pop up a little bit again in the short term? I'm going to go to the chat. Okay, great question. So Avery Grauer, I met you when you were a little girl. All right, let's see. How do you write this up in the contract? You write this up, Janet, in the contract exactly like you would. You basically got to say seller to contribute. In this case, if we're using this exact example, seller to contribute, let's round it up, $7,500 towards buyer's closing costs. Simple, just like you would if you were doing it for regular closing costs. The fact that it's being used for buy down doesn't make a difference. So it's a really simple thing. If you have an option to do it and you want to revisit that with me, feel free to give us a call and we'll be happy to help explain it. But it's a really simple. It's just a simple. It's usually in the additional conditions paragraph or box on the New Haven on the standard New Haven contract. So. I have been talking. Does anybody else have any questions I can answer for you?
I have a question. I don't know if you can help me with it. Actually
Yes.
working with someone who's looking to buy a mobile home, a motor, a mobile trailer. What kind of financing issues am I going to run into with that? I know it's a total different ball game.
Right. So mobile homes and oh my God, the term just went out of my head. Give me a minute. Oh my God, that is so crazy. Do you ever have that? You're talking in front of people and then a word you use
Absolutely.
all the time. Yeah. Give me a minute. Okay. Mobile homes is synonymous with the term manufactured housing. Okay.
Right.
So I told you I'm in charge of all of the Northeast. So we see a lot of manufactured housing, AKA mobile homes in rural areas of Vermont, Maine, New Hampshire, up there, upstate New York. The thing you have to understand about manufactured housing is there's going to be criteria. So there's a couple of things. The first hurdle is what's the cost? Because if it's a small loan amount, we're going to run into problems with what's called the national points and fees test imposed by the government. So it's really hard in mortgage lending today to do loans under $75,000 or $80,000. And that's because as interest rates have gone up, there's a standard that the government has that says the total cost of the loan can't exceed X. And as rates have gone up, the smaller the loan amount, the quicker you hit that hurdle. And it means you can't lend. You just can't lend on it. So the first question always that we ask on a manufactured house is, what's the loan amount? Because if it's oftentimes I'll hear 30,000, 40,000, you're going to have to try to look for true mobile home financing in that case, not traditional mortgage financing. If in fact, let's say it's a $75,000 or $100,000 or $150,000 loan, then it's a matter of, is it going to be affixed permanently to the lot? And that's a condition. So if they want to buy a true mobile home where they get to move it from spot to spot, you're not going to be able to get traditional mortgage financing. If it's going to be permanently affixed, then there is some possibilities, and there's a whole bunch of restrictions that we have to go through to do it. But at that point in time, we would take a look at what those guidelines are for you.
And you can offer that through
Yep.
Oh, all right.
Yeah.
Awesome. Thank you.
Yeah, so like I said, first hurdle is what's the amount? And then the second is it going to be permanently fixed? Well, if the answer to that is like 100,000, and yes, it's going to be permanently fixed, then you want to give my office a call. Give me a call and we'll go through what the other guidelines are, okay?
Great, thank you.
Do we have to tell the seller it's for a buy down? You know, I think that you don't have to tell them, but I think for you as the agent, I would recommend explaining the strategy to them so that they can see that like you're the best in the business, right? You're looking for ways to bring more buyers in, to make their listing stand out, you know, to move something that maybe wasn't moving before. And, you know, maybe you start this as an interim step before the price reduction. You know, eventually maybe you have to come back to the price reduction, but this might be a good stepping stone to get there. But at least it, because you know, when a house doesn't sell, listen, we all know the name of the game, right? If their house isn't selling the way they want it to, they're going to start blaming you. But if you come in and you can explain this strategy, you're going to absolutely present yourself for good reason as being an agent who's got all the latest tips and tools and strategies at your fingertips to help your sellers.
Yeah, that was kind of my question, was on the buyer side, because I work with mostly buyers. Should I mean, I probably would just verbally talk with the listing agent and let them know
Correct.
the strategy, but I wanted to know if I had to actually write that in the contract or no. It's
No,
okay.
it just has to say towards buyer's closing costs.
Okay, got it.
Okay.
Yeah.
So, and then Kim, you're asking for my contact information. I'm going to send out the presentation that I just did, and all my contact information is on the front page. And when you get the email, you'll have all my contact information then too. Would love to talk to anybody one-on-one about doing business together in 2023. All right. This is a record. I only went over 9 minutes. I'm pretty proud. It's a good day. Happy Friday, everybody. Any other questions before I go?
No, thank you so much for the information.
I
Happy
hope
New
it was
Year.
Thank you so
helpful.
much.
Excellent. Excellent job.
Thanks, Alan.
All right. I'll see you later.
Bye now.
Bye-bye.